So you're building a startup in India. You know it's a grind. It's an ambitious journey. But what if I told you that you could actually fuel that journey with some serious financial superpowers that are backed directly by the government? We're about to break down some incredible tax benefits that could literally change the game for your bottom line. Let's dive in.
And look, it doesn't matter if you're just in the planning stages, sketching ideas on a napkin, or if you're already up and running. The next few minutes are going to be absolutely crucial, because we're talking about strategies that could fundamentally change your company's financial future.
All right, let's just cut right to the chase, shall we? What if you could legally, and I mean by the book, pay 0% tax on your profits for years? I know, it sounds a little too good to be true, right? But it's not, and it's just one of several powerful incentives we're about to unpack.
Okay, but first things first. Before we even get to the good stuff, the benefits, we have to understand something really important. In the government's rulebook, not every new business is a startup. To get these tax savings, you need the official golden ticket.
And that golden ticket? It's called DPIIT recognition. Seriously, think of this as your all-access pass. It's the official stamp from the government that says, yep, this is a legit startup and they're now eligible for all the special perks and benefits we offer. Without it, you're basically locked out of everything we're about to talk about.
So what does it take to get this recognition? Well, the government has a pretty clear checklist. First, you've got to be a private limited company, an LLP, or a partnership. Your annual turnover can't be more than 100 crore rupees. And here's the real kicker. Your business model has to be genuinely innovative or scalable. You can't just take an old business, give it a new coat of paint, and call it a startup.
I really need to hammer this point home. No DPIIT recognition means zero benefits. It is the absolute, non-negotiable first step. You cannot skip it.
All right, so you've got your golden ticket. Now let's talk about the rewards. First up is a massive one, especially for any founder who's raising capital. It's called the angel tax exemption, and it's all about protecting that crucial early-stage funding you get from investors.
Here's how it works. Normally, if you issue shares for more than their face value, which you always do when fundraising, that extra cash could get taxed. But this exemption saves you, as long as you play by two key rules. First, your total raised capital can't be more than 25 crores. Second, you have to use that money to actually build the business, not to invest in things like land, fancy cars, or jewelry.
Okay, and here is a huge, time-sensitive update. Please pay close attention to this one. These specific angel tax provisions are going away, starting from the 2025-26 assessment year. This is a massive change, and it means the entire fundraising landscape is about to shift. You absolutely need to factor this into your financial planning, starting right now.
Now let's talk about the benefit that gets everyone really excited, the one I teased you with at the very beginning. This is about the power to keep 100% of what you earn. This is just an incredible way to help you grow in those critical early years. You get to pick any 3 consecutive years within your first decade of business and claim a full 100% deduction on your profits. I mean, think about that. It's basically a 3-year tax holiday that lets you pour every single rupee back into growing your company.
But you know, a superpower this big comes with some very strict rules. Your company had to be incorporated within a specific window, between April 1st, 2016 and March 31st, 2030. You also need a special certificate from what's called the Interministerial Board. And of course, you have to file your audit reports and tax returns on time, every time. There's just no wiggle room on this stuff.
But wait, you might be thinking, what if I'm not profitable yet? And that's a great question, because most startups aren't, right? That's where our third major benefit comes in. You can think of it as a crucial safety net that gives you a ton of flexibility when you need it most. So for a normal company, if they want to carry forward their business losses to future years, they have to maintain at least 51% of the same shareholding. Now, that's a huge problem when you're fundraising and bringing in new investors. But for an eligible startup, that rule is relaxed. As long as your original shareholders are still part of the company, you can carry forward those losses, even if new funding rounds have totally changed your ownership structure. It's a game changer. Of course, this benefit isn't forever. The safety net is specifically designed to help you in those tough, formative years. It only applies to losses that your startup racks up within its first 10 years of operation. So, we've just covered 3 absolutely incredible benefits. But listen, getting them is only half the battle. If you want to keep them, you have to play by the rules. Staying compliant isn't just important, it's everything.
So let's make this super simple and actionable. Here's your compliance checklist. Number 1, get that DPIIT recognition. That's step 0, you have to do it first. Number 2, use your funds the right way. Remember, avoid those restricted investments we talked about. And number 3, file everything on time. Your audit reports, your tax returns. Remember, due dates are deadlines, not suggestions.
And that really brings us to the final thought I want to leave you with. You're pouring all of your blood, sweat, and tears into building an innovative product or service. So the real question is, are you applying that same level of innovation to your tax strategy? Because when you do it right, it's not just about saving money. It's about actively pouring rocket fuel on your growth.